Hello and welcome to Big Deal. I'm Nisha Poddar. Now today the focus is on the equity market deals which rise as soon as the market gains some momentum. But there are many headwinds that are facing the economy which have kept the markets volatile, and this particular factor changes the deal scenario. Let's understand from our experts joining us today on Big Deal, Deepak Ramachandra, the Managing Director and Co-Head of Equities at Axis Capital, and Rahul Arora, CEO of Nirmal Bang Institutional Equities. Gentlemen, so good to have you on CNBC-TV18. Now, Rahul, first give us your view on the market. It has been volatile, market has been tentative on the 18,000 levels, and there is inflationary concerns as well as interest rate hardening scenario. How do you view the market trajectory from here on?
Thanks for having me on the show, Nisha. So I think you summed it up pretty well. I think, we're looking into a slowdown/recession in the calendar 23. This is going to be coupled with a slightly high inflationary scenario. Even though inflation will probably directionally come down, it's still going to be higher than comfort levels for most central banks. And I think the effect of the interest rate hikes that you've seen from global central banks, India included, still need to be felt at the economic level. So I think a sum total of all of this, Nisha, if you look at calendar 2022, there have been at least 4 or 5 attempts when the Nifty has gone to this zone of 18 to 18,300, but finds it difficult to sustain there because I think people then start taking cognizance of the fact that probably valuations are running ahead of themselves. So my sense is, Nisha, 2023 is going to be a very tough year to make money in the capital markets. The journey from 7,500 at the peak of the pandemic to 18.5 was a relatively easy one. But in the face of fixed deposit rates, for example, rising as well, I think it's not going to be all that easy to defend the kind of returns that you've seen. So be moderate, be tempered, but there will be an opportunity aplenty. But, this is the first sort of global crisis that we're looking at since Lehman in this big a fashion. So we should probably have our front and rear seatbelts on as we approach the year.
All right. So very cautionary statement there, Rahul, and rightly so, because we have a spate of bad news really coming in with the recent spate of layoffs also, putting a lot of pressure on the overall sentiment for the business. But Deepak is right here with me in the studio. So Deepak, good to have you on the show. And this is your debut attempt, so we'll try to draw as much from your experience as possible.
Thank you very much for having me, Nisha.
Yes. So iBankers have been a very busy lot. Market volatility makes deals much more difficult. Timing it exactly at the window and then making returns, because the biggest theme that I have seen in the last 2 spurts that the markets have seen is the onset of investors cashing out of their vintage holdings. How do you see the overall scenario, and how difficult is it to time the volatility?
I mean, timing is always the biggest challenge, right? But I think, with everything that Rahul has said, I think a lot of investors are getting more cautious. But the equity markets and the deal markets are telling us a slightly different story as well. I mean, last year we had a bumper year, right? There were, I think, 55 IPOs raising 1,25,000 crores. This year has been slower. I think till date we've raised about $6 billion, that's 45,000 crores in 20-odd deals, 24, 25 deals. So it's been much slower this year, but almost as we speak, I think the market's picking up.
Yes.
And the deal activity has picked up. I mean, October we had just 1 deal, but so far this year 4 or 5 deals have closed. Our team, we closed the BKG deal and DCX. Those went very well. And from what I can see, we're working on 3 or 4 more, and the market has 12 odd deals, right?
Yes.
So the pipeline is strong. The appetite seems to be there for the right, the right kind of businesses at the right price. And, with all the headwinds that Rahul spoke about and we read in the papers and you talk about, India is really the preferred destination today, right? And, with the headline that we see on all the foreign selling and stuff like that, that has already abated. And there's really not many other places, funds can flow to. So we're, in a way, in a very nice spot, despite all the global headwinds that we're facing.
All right. So timing the market and catching on that window has been one of the very important tasks that iBankers have performed. But Rahul, Deepak was talking about some of these IPOs. What's your view on the quality of IPOs which have made it to the market to take advantage of this window that was presented?
So I think the one thing that's different, Nisha, and I take Deepak's point very well. I think it's the kind of IPOs that are hitting the street, because I think if you remember, Nisha, we had done a show about 15 or 18 months back where, you had a lot of these new gen companies, the Nykas, Paytm, Zomato's, Policy Bazaar, car trades of the world that were listing. And India was suddenly exposed to this terminology of gross merchandise value, or GMV, and client acquisition and retention and disruption. But you found that as soon as liquidity started receding, it went back to the conventional theory of return on equity and return on capital employed. So I think a lot of the deals that probably Deepak also spoke about that have been happening for the better part of the last 6 to 9 months have been focused in this direction. You've had a defense IPO recently. He mentioned the BKG IPO that his firm worked on, again, a very profitable company. You have an NBFC company whose IPO that's currently open. So I think the focus has shifted away from the easy liquidity money to quality money and sparse money, because you are in a situation, Nisha, where liquidity is being tightened. So I don't think people are going to throw it at companies where there are going to be incremental losses from here, and private equity or capital market investors funding those losses. So I think there is a definite tectonic shift in the kind of IPOs that are coming to the market vis-a-vis what it was 18 months back, and the kind of discerning money that's going in. I mean, just take a look at the subscription numbers on BKG and it'll tell you a story. So I think, Nisha, the interesting part is that even at a 7,500 Nifty, there will be stocks that are expensive, and even at an 18,500 Nifty, there will be stocks that are cheap or that present value. So I think if you approach the market from that perspective, where you try to marry value and growth and keep the conventional wisdom of return on equity and capital employed at the heart of your business making decision, I think life can be a lot simpler.
That's right. Market is asking all the right questions now from any of the papers which are available in the market. What's the bottom line? And I must tell you, Rahul, in that particular show, we broke it down and called it out that, these valuation matrices would not hold for too long, and that the liquidity infused euphoria is very fleeting in nature. But one question before I move to Deepak on these IPOs. Rahul, do you think that a resurgence of the new age companies, IPOs, is going to get a shot in the market anytime soon?
They will definitely test the waters from time to time, Nisha. But I think the kind of plethora of IPOs that you saw in the better part of the pandemic, I don't think that kind of gush of IPOs is going to come back. I think it's going to be the more traditional companies that are going to come back. I mean, even if you look at a lot of these companies, right? I mean, look at what a Nykaa had to do to just prevent the lock-in from going away. They had to issue bonus shares. Zomato is now talking about, okay, fine, client acquisition was a thing of the past. We are focused on profitability. So I think the promoters themselves are being forced to think of ways to, get profitable and hold on to their investors when the time of lock-ins go out. So Nisha, I think the only other parallel that comes to my mind, and maybe my career has not been as long as a lot of investors. I've been in the market for about 20 years, but the only parallel I can draw is 2008, when a lot of real estate IPOs came out, and how many of them do you even talk about today, right? 14 years hence, you probably had just a handful of them. So I think the disruptors themselves could potentially get disrupted from an investment standpoint, and it's very possible if you're having this conversation a decade from now, a lot of these companies probably won't be discussed, but a lot of the IPOs that have come out in the last 6 to 8 months will not only stand the test of time, will probably grow into maybe the mid caps into large cap companies. So I think that's probably the one thing that I'm thinking of that's probably visibly changing.
All right. So profitable companies, more traditional in approach, they are the ones which are still getting picked up by the investors. Deepak, what are you suggesting and advising to your clients? Are there enough new age companies which have been looking for cash and to raise funds, but do you think that they will have the appetite in the market?
I think, Rahul alluded to it as well, but I think if there are some fantastic companies out there, right? But I think the crazy valuation metrics that we saw in the liquidity-infused euphoria are no longer sort of relevant, right? So investors need to be more discerning in how they're valuing it and come back to more traditional metrics. But there are some fantastic companies there, and if they can demonstrate a path to profitability, I think there will always be appetite because, I mean, that's where the innovation is happening. happening. That's where the disruption is happening. And we would always advise investors to look at them for the intrinsic value of that business and how soon they can get profitable. So I think there will be appetite for the right business and again at the right sort of price.
So are you looking at a scenario some time from now where some of these new age companies with a much lower valuation expectation could make it to the market? Is there any timeline in mind? Is the work going on that front at all?
There's a lot of work going on, and I think in the year ahead, we are seeing, $4 or $5 billion of sort of IPO pipeline in the new tech sort of tech space, and some of them are very, very good companies, like I said. Valuation and depending on how the markets are at that time will always, will determine whether they come to market or not. But I think yes, there will be a window. Again, like you said, timing is always key. But I think given how people have burnt their fingers in the past, the way they will approach the valuation of these companies will change. And I think that has probably changed for good.
All right. So a new normal in the valuations of these companies in a new market environment is something to be watched out for. That's an important takeaway. In fact, on that note, I'll quickly take a short breather while you digest all the points that have been made by our panelists, and we'll take the conversation forward on the other side. Stay tuned to Big Deal.
आज ध्रुव के स्कूल से फोन आया, कहने लगे कि फीस भरो वरना कल